All right. Hello, lovely people, and welcome. Thank you so much for joining us today. Our speaker for this lecture is Avi Gilburt, the founder of ElliotWaveTraders.net. Avi is widely recognized for his remarkable accuracy in pinpointing market moves, and today he will be sharing with us his updated views on the stock market for 2022. Wonderful viewers, please type any questions you may have into the live chat box. Time permitting, I will announce your questions to Avi at the end of his presentation so that he may answer them. And Avi, if you need anything at all, I'll be right here on mute. The floor is all yours.
Thank you so much. Good afternoon, everybody, and thank you for joining us this afternoon. I know a number of you here you've come to hear my modified expectation in 2022. And we will get to that. I will explain that as we move through the charts. As you heard, please, we're gonna take that. You could take down your questions. You could put your questions in, but I will leave time for questions at the end of the discussion. Oftentimes, a lot of the best information comes out through questions. So I'm going to try and limit my presentation to maybe about 20-25 minutes. This way we could spend a good 15-20 minutes or so on the questions. If I'm a little long-winded, it may take a little longer, so I apologize, but I will definitely leave time for questions at the end. In the meantime, let me explain to you guys that I am an Ellitician. Well, what the heck is an Ellitician? Well, an Ellitician is somebody who views the market through a very different lens than most analysts. Whereas most analysts view the market through the lens of fundamentals, I view the lens through a perspective of market sentiment. Well, what is that? Well, back in the 1930s, Ralph Nelson Elliott identified that society moves through its path in waves. Elliott identified that movement occurs in a 5-wave structure in the primary trend and a 3-wave structure in a corrective trend. Elliott also identified that the market is fractal in nature. What does that mean? Well, it means that it's self-similar at all degrees of trend. Now that you guys are probably saying to me, well, what the heck does that mean? Well, effectively, what Elliott identified was the market moves in a 5-wave structure, and it moves in waves 1, 2, 3, 4, and 5. Wave 1 is in the direction of the primary trend. Wave 2 is a corrective pullback. Wave 3 moves in the direction of the primary trend. Wave 4 is a corrective pullback, and the final wave, wave 5, moves in the last movement within the 5-wave trend. But interestingly, what Elliott identified, and this is where it comes in that it's fractal, it's self-similar, it's variably self-similar actually at all different degrees of trend. It means that waves 1, 3, and 5 that move within the primary movement of the trend also break down to 5-wave substructures within them. And as you keep delving further and further down into those substructures, each substructure in the primary trend within those substructures will also break down into 5-wave substructures. So as you go all the way down, I've got a chart here on the screen that represents 100+ years of the S&P 500. And you could see that, we've labeled this in 5-wave structures. Now, of course, you can go further down into a standard monthly chart, into a weekly chart, into a daily chart, into an hourly chart, even into a tick chart. And you will generally see the same structures being developed as the market moves through its progression. And that's what we really mean by the market is fractal. It's variably self-similar at all degrees of trend. And that helps us in identifying the general context for the market. And that is something that, when I was growing up and I was learning fundamental analysis, one of the tough parts of investing is, sometimes it's easier to identify when to buy. When you see a washout, that's a great time to buy. When do you sell? Everybody is always confused. When do you sell? That's what Elliott wave really gives to us. It provides us with a general context to the market that you'll find in no other analysis methodology. So let's take a look at the context to the larger degree trend, and then we'll move towards our smaller degree structures. As you can see on this chart, we're looking at 100 plus years on the S&P. Now, I want to start back here starting towards the left side of the chart. You'll see the Wall Street crash of 29. And if you look closely, you'll see a paren Roman numeral 1 right before that crash began. It then crashed straight down into what began the Great Depression, and it bottomed at Roman numeral paren 2 about 1930 or so. So the crash took about a year or two. So that was a pretty quick washout of a crash. And that type of crash set up this major rally that we have now seen off of those lows. Now, I'm going to tell you something that still blows my mind, and we have it on the chart. Back around 1940 or so, I think it was 1941, 42, somewhere around there, Ralph Nelson Elliott gave us what probably was the most incredible prediction that I've ever seen in my life, and I've done a lot of research on market history. Elliott said in the early 40s, he said the market is basically about to embark on a 70+ year bull market. Now, let's put yourself in his shoes. It was around the time of World War II. World War II was raging around the world. And the United States was just getting into World War II at the time. They were really ramping up and moving into the war in a big way at this point in time. And you know, to come out and say that, you know, it's now World War II and you're expecting a 70-year bull market, I mean, that is a pretty amazing prediction. But the reason Elliott was able to come up with that prediction is because he understood the context of the market in general. He understood it at the larger degree and he understood it at the smaller degree. And I'm going to show you, I'm building on Elliott's work, and I'm going to show you where I believe we are today. Now, if you look at when I showed you paren 1 and paren 2 in Roman numerals, I want you to now look at the top of the chart on the right side. Do you see that paren 3, Roman numeral 3 up there? Now, I want to go back to what we said earlier. Remember, a 5-wave structure is what Elliott identified, and it tracks market sentiment. That's really the driver of things. You know, when you wonder, you know, why does the market go up when bad news comes out, or it goes down when good news comes out? It's because the substance of the news is really not terribly important. Rather, it's where we are within the trend that will give the interpretation to how the public will accept that news. If we're in a positive trend, the public is going to discount bad news. If we're in a negative trend, the public is going to discount good news. And that really explains the market in a much simpler way than trying to, you know, scratch your left ear by going over the top of your head with your right hand to scratch your ear. Sometimes that's the type of mental gymnastics that you'll hear from fundamental analysts when the fundamentals really don't make sense to them. This is a very simple way to look at the market. Just to give you another example. How do you know when a market's going to top? When everybody and their mother is in. So when you have everybody in, there really is no more money that is left that's going to come from the sidelines that's going to push the market up. And when you're now at hitting a wall on the upside, well, where's the only way you're really going to go? And that's the downside. And it works even better when the market is dropping precipitously. The best example was probably March of 2020. The market was tanking. I mean, we had 100, 200 point moves a day in the S&P 500, and that thing was tanking. And I went out there and I said, 2,200 is my number. From 2,200, I think we're going to a minimum of 4,000, ideally 6,000. How did I know that? Well, market context that Elliott provided for us. So, and it told me that 2,200 number was the mathematical point at which I believed that the market was going to exhaust itself to the downside. And when you have no more sellers, where are you going? You're going right back up. And that's pretty much what happened. So getting back to this, if you see the Roman numeral paren on the top, that is the third wave, the Roman numeral 1 and 2 that we had around the Wall Street crash of 29 that led into the Great Depression. That was wave 1 and 2. We're now approaching the end of wave 3 from that 1-2 structure. And what did I say happens after we finish off, the trend move in the wave 3 that moves within the trend? Well, you're going to get wave 4, which is a corrective pullback. Now, it sounds really nice when I say it so simplistically. We're going to get a corrective pullback. But imagine if we're going to go from the 6,000 region back down to the 1,000 region. Does that sound so nice? It's not. I'll go into the smaller degree. I'm going to move through the wave degrees as we speak. But just to show you what I'm talking about, I want you to look towards the middle of the chart, and you'll see where, by the way, this chart was put together by Garrett Patton. He's one of our top analysts at Elliott Wave Trader. If you see, he labeled it about the 2000 tech bubble. You'll see Roman numeral 3, not Roman numeral paren 3, which is at the top, Roman numeral 3. The market topped out there. And then, as you see, we had an ABC structure for Roman numeral wave 4. That basically took us from 2000, when we hit the top, to 3, until early 2009, where we finished off Roman numeral 4. And that started Roman numeral 5, which is now completing the 5-wave structure for Roman numeral paren 3. And that's where we are in the larger degree structure. Now, one of the other things I want to point out, and I'm going to move into the monthly chart in a minute, but one of the other things I want to point out is Elliott also told us there's a theory of alternation. What does that mean? It means the structures between corrective patterns will alternate. For example, wave 2 paren that led us into the Great Depression was basically straight down. I mean, that was the market crash of all time. Straight down. Pretty much, you look at the chart, straight down. Nothing is more straight down than that for that prolonged period of time. That was a straight down move, happened fast, got it over with, ripped the Band-Aid off. Let's move over to wave 4. If Elliott's theory of alternation is correct, it means that wave 4 is not going to be something that is just going to go straight down, pull the Band-Aid off and fast. No. Wave 4 is going to take a lot of time. It is going to, it's absolutely going to take its time. It's going to be very, very difficult. It's going to lead to a very difficult time period in both market as well as society. Because what we've learned through the market is that the market is a barometer for society. And you could see that throughout all of history with the market. But what I'm looking for in wave 4, whereas if you look 1 degree down, I just showed you the 2000 to 2009 wave 4. That was a wave 4 of 1 lesser degree. That was a 9-year correction, folks. And that was of a smaller degree. If we're now going up to a wave 4 in paren of a larger degree, I'm pretty confident that it's going to take us longer than 9 years. In fact, it would not shock me if we doubled that amount of time. So that's why I say we may be heading into a multi-decade bear market in the bigger picture. And that's the bigger picture. It could be a multi-decade bear market. And that's what we're showing here. So let me, now that I've given you the bigger background, let me move into the smaller degree charts. And there we go. Okay, here we go. Now, let me go back a second. I want to show you where we are, just so you know. Remember I showed you that drop into the Roman numeral wave 4 from 2000 to 2009, and then we had that Roman numeral wave 4. Well, now I'm going to zoom in on that. This was the drop to complete that Roman numeral wave 4. So I'm now in a monthly chart that is now showing you the progression of our analysis that's taking us to ideally complete this larger Roman numeral wave 3 in paren. And as you now, let me take you a step back. What the context to the market provided for us was this back here. The market topped out here, which is where we generally expected it off of this move here. If you remember, for those that followed me many years ago, when we were at the end of 2015, I was saying market's going to pull back from the 2100 region. It's probably going to go to somewhere around the 1800 region. And then we're going to begin what I called for as a global melt up. I was looking at risk assets to be taking off all across. And that is pretty much what we got through 2016 and 2017. In fact, I even said that when we were going into the election, I said, I don't care who is going to be elected. The market is still heading to 26. I said we were going to go from 1800 to 2600 plus. And I said it before we even began the correction into the early 2016 low. And that is exactly what happened. The market did not care who was elected. People thought the market was going to crash because of Trump. No, the market was still setting up in the same manner as we were presenting it. And that is exactly what happened. Now, since then, we saw a large correction. Now you're looking at this higher B wave that we struck in early 2020. I'll be honest with you. I did not expect a corrective rally that high. We've seen many corrective rallies that can, in the middle of a corrective rally, that can make a higher high, but that one was quite stupendous. What was most interesting was as we were topping here, I said the degree wave 4 that was alongside this wave 3, this wave 4, I said my ideal target for this wave 4 was 2200. I said it in early 2018. And that is exactly where we bottomed. So as we were approaching that 2200 region, the market context that we've learned from this Elliott wave analysis told me that was a great buying opportunity. And it has been. And I don't think we're done yet. I still think we have more to go. As you can see, we still need to fill out this final fifth wave in the fifth wave of the fifth wave off of that the Great Depression low. But keep in mind, we are coming up to a major top. And once we complete that major top, I'm looking for a major bear market, not something that's going to last a couple of years. I'm looking for a major bear market. Now, what Elliott has also told us is oftentimes when you get a larger degree fourth wave, where does it go? Most often you go to the fourth wave of one lesser degree. That's a general target you would normally have. Folks, that is 666 on the SPX. However, he also told us that when you get an extension, a strong extension off of that low, then the more ideal target would be the second wave pullback in that 5-wave rally. That puts us at about 1,000. So right now, folks, my larger degree picture is once we complete this rally up to around 6,000, I'm looking for a massive bear market that can take us all the way back down to 1,000. Now, in the best case scenario that I can come up with, I'm looking for 1,800 to 2,200. That's the best case scenario that I can come up with. So in the best case scenario that I can come up with, and that's an alternative view at this time, the best case I can come up with is we're only going to see 4,000 points shaved off the market. So I'm looking for a very serious bear market. But in the meantime, let's look at where we are on the smaller degree. Let's hone in a little bit more. What I'm going to do now is from here to here, I'm going to hone in on the daily chart and show you how this is transpiring. Okay. And to be honest with you, it is moving. I mean, I can't tell you how perfect this structure has absolutely been. Now, as you could see, you see this 0.382 of wave 3. I set this target up here. I identified this target here. And ultimately, that's where we came down. We bottomed, and I expected that we're now going up to here. Now, where are we within this structure? Now, if you look at the smaller degree counts on here, you'll see things are being counted in 5s. And I have multiple wave degrees on this chart that are counted in 5s, as you could see. And this is what I mean by the market is fractal in nature. It is variably self-similar at all degrees of trend. So every wave within 1, 3, and 5 is subdivided into 5 waves. And even those are subdivided further. And that's what you can see I have on the daily chart. Where are we right now? Well, where we are right now, and I'm going to try and do this as easily as possible, but I know for some people, you may be glazing over, at this being Elliott wave analysis, and it's not the easiest analysis in the world, but I'm going to try and explain it as best as I can. Once we rallied off the bottom in March 2020, we saw a really nice 5-wave structure. And that was the first wave. That first 5 waves up was the first wave of this wave here from 4 to 5. So once we had this wave 2 pull back after that, remember, corrective pullback, it now gave us amazing projections for the rest of this 5-wave structure. And that's what we call our Fibonacci pinball methodology. Now, I'm not going to go into the great details, but I'm going to say this very simply. When you have this 1, 2 in place, it often projects to the 1.618 extension of this 1, 2 for this 3. So my target for next year, ideally, and I think we can get there next year, and I'll go into the smaller degree to show you why. But my target for next year is ideally the 5,500 region. I think we can get there by the end of next year, maybe early 2023. It really depends on how fast the market moves at that point. But in the meantime, I'm now required to subdivide this structure for this wave 3 into 5 waves as well. So I've got 1, 2, 3, 4, and 5. Right now, I see us as completing the wave 3 of this wave 3. Now, the ideal target for that wave 3, which is what our Fibonacci pinball structure tells us, on the larger degree, our ideal target is the 1, 2, 3, 6 extension of waves 1 and 2, which is just over the 4,900 region. So for those of you that were following my analysis, you may have remembered that I was saying we're going to top somewhere around the 4,600 region, and then we're going to pull back about 200-300 points. That was the 3-4 in this wave 3 that I was expecting. And now we're heading up. And then I said, from here, we're going to go to 4,900. That's how I know, or not know. We deal with probabilistic analysis. Am I absolutely going to know 1,000% what the market is going to do next? No, I am not God. But rather, the market has given us structures that tell us these repeat enough over time that it's a high probability that it's going to happen. That's why this was a high probability. This was going to be a major bottom that's going to lead us much higher. That's why I said this is a high probability we're going to top in this region and get a 200 to 300 point pullback before we continue to 4,900. And right now, I'm believing we're going to top in the 4,900 region, and we're going to pull back probably to around the 4,440 region is my guesstimate at the moment. And from there, that's when we're going to go up to 5,500. Now, let me take you into the 60-minute chart. My initial expectation when I gave my last presentation to those of you that came on the Money Show, on my last presentation, my expectation was this wave 3 that's going to take us up into the 4,900 region was not going to top. I didn't think it was going to top until the end of the first quarter of 2022. When the market just went straight up parabolic like it did, it has shortened the timing that I had been expecting. And that is the major change in my analysis from the last time you may have seen me. My expectation at this point in time is I'm looking for at least one more push higher towards that 4,900 region, preferably two more. It may even push out a top for this until early to mid-January. But my expectation is over the next month or two, I'm expecting that we're going to see a sizable intermediate top. Why do I say sizable? Well, remember, I'm expecting for us to go from 4,900 back down into the 4,440 region. 4,440 to 4,485 is my ideal target as it stands right now. We can drop as deep as 4,300, but right now my expectation is only here. And as it progresses, we'll be able to identify that a little better. But what I'm really trying to convey is we're likely going to see the largest pullback that we have seen since we began this rally back in March of 2020. And so right now, my expectation is for something around an 8 to 10% correction. Could bit more, maybe a 12 or 13% and get down to 4,300. It can, but right now I think the more reasonable target seems to be the 4,440 to 4,485 region. Now, and I can assure you, I'm going to prepare you for this. I say I'm not God, I'm not a prophet, but I will tell you this, and this is something you can bank on. If we're going to get this type of pullback that I'm showing here, that I'm expecting as we move into the first quarter of 2022, I can guarantee you that the great majority of the articles you read, the analysts you listen to, whatever you want to talk about, I can guarantee you they're going to tell you the bull market is over. And I'm here to tell you that the bull market is not over. That is going to be your next major buying opportunity. If you listened to me earlier, I said it was a major buying opportunity on this 200 to 300 point pullback, because then we're going to rally up towards 4,900 from there. And it has been a phenomenal move. I am telling you, this will be an even bigger opportunity. Why? Because I'm going to go back to the daily chart to show you. Once you get this pullback in 4, remember, we have 5-wave, we break down into 5-wave structures. What happens when you get a 4? Well, I know I can count to 5, means we get 5 next. And the ideal target for that 5 is in the 5,500 region. So if we're going to get this 4, and everybody is going to tell you the bull market is dead, I want you to tune out all the noise. Look to buy this pullback and just put your stops below 4,300. Give yourself a little bit of room, because from 4,440, I'm looking to rally 1,100 points, folks. 1,000 to 1,100 points, shall we say. And I think we could even see that completing by the end of 2022. It could take us 9 months to get there, but I think we could see it happen that fast. So in general, that was really the change to my analysis. And it really came down to the timing because of how fast this move occurred. I did not expect us to be moving straight up parabolically like this. But due to the nature of how fast this became, and I still think we can get some more backing and filling here and moving higher until we complete this up. But once you get over 4,800, folks, I think you have to recognize that, the upside potential is significantly outweighed by the downside risk at that point. So I'm personally going to be raising some cash. I'm telling my subscribers and my clients that I'm raising cash, and I've given them my entire plan. It's really pretty simple. Raise cash here, buy big here. Really simple. And I'm looking for 5,500 after that. So that really is my general expectation for 2022. So maybe we move into some questions. We have about 15 minutes left. So maybe we move into some questions.
We do have quite a lot of questions that have been coming in, Avi.
Not shocked.
Absolutely right. Okay, now let's see if I can start with a simple one. Ron Vincent has asked, what is the wave saying about the low for the three major indices? And I believe this is a two-part question because he then put
I don't understand that
DJ,
question.
yeah, DJ, S&P, and NASDAQ.
I'm not sure I understand what that question is referring to. What makes
Okay.
it low? I don't necessarily understand that question.
We'll see if maybe during this time he might be able to reiterate that question in the chat for us.
Guys, when you post questions, please post questions in full sentences, because sometimes it really is hard to understand the questions that are being asked. You may be thinking something and typing something very quickly, but please, I'm telling you, it's much better. I do live videos for my members every single day. So I know I'm used to it, and they already know you got to really type out in full sentences.
Absolutely. Here's a good one from Mike Pascale. Hello, Avi. For newbies, could you briefly describe the difference between the stock waves and market pinball wizard services? Thank you.
Okay, I mean, I'll get into that quickly. Stockwaves focuses on just US stocks. We have a team of 4 analysts that will pop out analysis of individual US stocks, and oh my God, the amount of stuff they cover is insane. And the Market Pinball Wizard is just, and which is the same as our Elliott Wave Trader platform. It basically is what I cover is general markets, the S&P 500. I cover gold and silver as well as GDX. I cover USO, and we also cover the Dixie. And you know, we have 20 some odd analysts on Elliott Wave Trader, so there's a lot more stuff going on in there as well.
From Donald McBurney, do you recommend playing individual stocks or indexes in your pinball strategy, or both?
Excellent question. That is an excellent question. The pinball structure, I mean, is golden when it comes to the indices, as well as it works on any chart, any product that has mass sentiment built into it. So clearly, the general stock market is ideal to use it in. But when you move into stocks, remember, not all stocks are going to display mass sentiment. When you have a micro cap biotech company, it's not going to display it. You're going to have points where, you know, it'll work. But I will tell you, if you're dealing with a micro cap biotech, you're going to get a fundamental issue that crops up, and it will break the pattern, because it all is based upon a continuum. Look at Elliott Wave analysis application on a continuum. The higher the mass sentiment being displayed within a particular product, within a particular stock, you know, like a mega cap. A mega cap is no different than the SPX. No different. You have the same type of mass sentiment, and it works amazingly with mega caps or with big caps. When you start moving towards the smaller caps, you know, maybe even the mid-size, not the mid-size as much. Mid-size, it works still very well. But when you start moving to the smaller caps and the micro caps, you got to know your fundamentals on those. So that's how I view utilizing Elliott Wave analysis. If I intend on investing in a micro cap or small cap, I need to know the fundamentals. But at the end of the day, I just don't have the time. So I really don't invest in those very much. I stick with mid-size to large to mega caps. That's really what I'm focused on. And all I have to do is look at a chart, and it tells me all I need to know. So, but if you're going to be looking at the micro caps, the smaller caps, you need to know those fundamentals.
Another one from you know what? Another one from a lovely viewer is asking, during the upcoming Thanksgiving break, do you see the S&P pulling back? And if so, by how much?
Let me show you the smaller degree chart, folks. This is my smaller degree chart. And what it's telling me is that my expectation is, as long as we hold 4650 on this current pullback, I'm looking for a rally to 4800. So we're probably, as long as we hold 4650 right now, guys, I am looking for us to rally to 4800 from here. So that's the plain and simple of it.
Now, please excuse me if I butcher this. Someone has been asking if you could explain wave Roman numeral 3/5500 to Roman numeral IV slash. I'm sorry. I thought I could ask that question, but it's a little
Okay, let's
confusing
move
to
on
read
to the
out.
next one then.
Yeah. Okay. Now, when you say raise cash when the SPX gets near 4,900, what percentage of your stock portfolio would you place sell stops?
That is a great question. I will usually not go beyond 10 to 15% of cash that I will raise. Why? Because I recognize it's still a bull market with much higher levels to go. I'm looking for price improvement. So that's really all I'm looking for. I'm not going to be taking myself out of the bull market. I am not all cash in, all cash out. The only thing we've done that for, and I got a funny story for you. Before we crashed in March of 2020, in February, so either the January or February, early February of 2020, I turned to my wife, who handles our kids' 529 education accounts, and I said to her, take the kids completely to cash. And then I told her when we were approaching 2,200, I said to her, put them back in cash. I put them back in the market. And the funny thing is, if you remember what it was like in March of 2020, people were freaking out. And my wife turned to me and literally asked me, are you sure? and she's not lived that down since. But that is the only account I deal with cash or fully invested. Everything else, for all the other portfolios that I have, guys, I will not raise more than 10 to 15%. And if I have a nice setup that's pointing us lower, I may even short the market. But I don't advise most people to be shorting the market during a major bull market. And I advise most people to really stay the course in a major bull market. We can get a 10% correction. It's just an opportunity for price improvement and to reallocate your account if you choose to do so. But I would not suggest you take yourself out of the market wholly. I'd be looking for price improvement, which is what I do.
All right. Ron Vincent has rephrased his question.
Excellent.
Let's see if this is answerable. He has asked, what will be the lows of all three indices in 2022?
First, I'm dealing with the S&P 500. My expectation, and I'll say this again, my ideal target, 4440 to 4485, outside shot as low as 4300. That's it.
Okay, thank you. And another question from Ed Van Passen is, will Europe have a similar pattern in timing as the S&P 500?
The answer is, depends on each chart. People ask me, let me show you I'm going to go back to the monthly chart. People ask me, well, what the hell do I do with my money if I'm coming out of the market during this? And I'm looking at this and I'm saying, you know what, we're going to get an A wave and then you're going to get a B wave rally. You're going to have corrective rallies during this, and they're going to be multi-year rallies during this, similar to what we saw in when you go back and you take a look. I mean, when you go back into 2003 to 2007, that was a multi-year corrective rally that wound up going back lower. And we're going to see many of those. I mean, we're going to see a bunch of corrective rallies through this bear market, but I don't expect any higher highs in these yet. When I go over and I look at the EEM, hold on, let me show you the monthly chart, or weekly chart rather. The EEM presents a very interesting opportunity. Whereas, I'm expecting we're going to go up to here and top here like we will in the S&P 500. But when the S&P 500 gets a larger degree A wave decline, I think that probably is going to be a fourth wave decline in the EM, followed by new highs, another drop on the S&P 500, another corrective rally in the S&P 500, which could be a much bigger rally in the EM. So there's going to be a point in time where I think there is potential for emerging markets to outperform the United States markets once we move into that bear market. So that's the long and short of it.
All right. And next we have Jeff Miller has asked, when do you see the 70-year bull market ending and at what level?
We just went through that. I mean, that's what I'm saying, 6,000.
So
that was what the whole presentation was about, Jeff.
Yes, we did have quite a few people asking for some clarification on that 6,000, but they were just a bit incomplete in their questions. So we'll move on then. And from Jared Krongold, we have, how do you use the Fibonacci time ratios on the 100-year chart?
I have done a significant amount of market research into various types of methodologies before I settled on Elliott wave analysis. One of the things that I've done a lot of research on prior to Elliott wave, as well as post Elliott wave, are timing cycles. Because how amazing would it be if we could project price and timing? I mean, you could just garner the market that way. But after all the years of research that I've done, I have never found any timing model that is better than 50%, which means it's a coin toss. And every cycles analyst that I have spoken to when I was going through my research about this, I've had one very simple question, and not a single one of them were able to answer it. The question that I had was, stock market is a non-linear environment. It's non-linear. How can you propose to place a linear timing box around a non-linear environment? And I can never get an answer to that. And I guess that's why it's 50-50. It's like a coin toss. I don't believe timing is anything you can get with any form of accuracy. I'm giving you my general expectations. These are guesstimates when I give you general timing. Like, I think we'll probably top in the 6,000 region around 2023, 2024, somewhere in there. I'm not giving you anything that is written in stone. I'm not giving you anything I think is high probability. I'm giving you a guesstimate. After all the research I've done, I have not found any timing model that is greater than 50%.
We do have someone also asking if you can comment on longer term interest rates.
Well, let's keep this to the S&P because we're running out of time.
Yeah, we do have some kind of repetitive questions for this S&P. Do you mind if I ask from Joe, when will you go to cash prior to the SPX reaching a top?
Which top? Well, I'm going to address that anyway.
Okay.
I'll address that because it's a really good question and people ask me all the time. I don't wait for the last minute. I don't wait to the last minute to start layering into a bottoming structure. I will start early and I will layer into where I believe we're bottoming, and I will do so at the top. So when we hit this paren 3 here, see this paren 3 that I'm circling? When we hit that 5,500 region, folks, I am going to be raising a significant amount of cash. I wouldn't even be surprised if I'm going to go as much as 60 or 70% cash at the time. I'm only going to keep those individual stocks that from their individual charts still have plenty of room to go. Outside of that, I'm going to be raising a significant amount of cash when we get here. Now, I'm expecting a larger degree pullback from here, and that will be the largest pullback we'll see at that point, but and still expecting one more rally, I can always trade this rally. I can just buy some SPY calls going out a couple of years, and I can buy some leaps on some SPY or whatever, and I could trade this rally going higher. So I'm not going to lose out. But let's say I'm wrong and I'm off by 1 wave degree, and this is the top. That for that reason, that is why I will be getting out of a significant amount of my holdings once we reach here, because I can always get back in here with a much tighter stop. But I will, if I'm wrong and this is actually the high and I'm off by 1 wave degree, I'll never get this back. So for me, I start layering in early and I start layering out early. So that's my spiel. And that's just based upon my own experience. Others may disagree. Others may think I'm foolish. Whatever it is, this is what works for me, and it has worked extraordinarily well through the years.
All right. Thank you so much, Avi. That was a fantastic presentation. And thank you for bearing with me and with all of our viewers through that question and answers. I'm sure everyone really appreciated it.
Thanks for having me here.
Absolutely. And to all of our viewers, thanks again for joining us in this wonderful live session. Avi, again, your presentation was magnificent. I hope everyone has a wonderful day.